what we're going to be going over here is the different inventory valuation methods that we'd be using in cost accounting here for evaluating our inventory. And we're going to be looking at the amount of cost that's really traced into the inventory using these different methods. So really we're going to be looking at 4 different methods here. We've got the throughput basis, direct or variable costing, and then we're going to have absorption costing here, and then activity-based costing. And what we're going to be looking at here is those inventory costs. If we use the throughput basis here for evaluating our inventory, this is going to have the least amount of dollars that's traced into the inventory, whereas activity-based, that's going to have the most number of dollars traced into our inventory. And as we move down here, move down from our throughput to our activity-based, there's more and more monies that are being traced into our inventory using each of the successive different valuation methods here. And we're talking about dollars that are being traced into inventory. We're talking about all those direct materials, direct labor, and those overheads, factory overhead, variable and fixed, and also the supporting functions like selling and administrative, factory and fixed. Okay, so let's go and let's start with our throughput costing here. So really what we're looking at is we're trying to determine the inventory that's going to be capitalized here for these different costs that we're looking at versus what is expensed. And it's expensed when it's incurred here, and we'll be comparing these 4 different methods. So starting with our throughput costing, this is the case here where we're going to have our direct material. The only thing that's going to be inventoried here in throughput costing is the direct material. So this is the inventory valuation method that has the least number of dollars that would be traced and included in our inventory here. Now, the other costs here are direct labor, our factory overhead, both the variable and fixed factory overhead, as well as our selling and administrative variable and fixed overheads are going to be expensed when they're incurred. And when I'm talking about selling and administrative, I mean all those other support functions, the engineering, the research and development, and so forth here that it takes to support the products we're looking at. But nonetheless, we're looking at, when we're talking about these inventory costs that are being capitalized, we're really talking about our direct materials, our direct labor, and then both the factory overheads, variable and fixed, and also those selling and administration amounts, variable and fixed. So throughput costing, the only thing that gets capitalized is the direct material that's going into our inventory. Okay, so that's the least cost, that's a method that we use for evaluating our inventory. Now let's move over here. Let's look at variable versus absorption costing. Okay, so starting with our variable costing, our direct materials, our direct labor, and our factory overhead, the variable portion goes into our inventory here and being capitalized. That's for variable costing. Now, for the factory overhead here, the fixed portion and all our selling and administrative, the variable and fixed portion, using variable costing, that gets expensed. The only thing that's being capitalized here for variable is the direct materials, direct labor, and the variable factory overhead here. Now, with absorption costing, that's the case here where what's going into your inventory or being capitalized in your inventory is your direct materials, direct labor, and not only the variable portion here, the factory overhead, also the fixed portion of the factory overhead here. So absorption costing is taking the fixed portion, and that's going to be included in your costing here for your inventory. So absorption costing is tracking more dollars into the inventory versus variable costing. And then with absorption costing, what is going to be expense for the period would be the selling and administrative expenses, both the variable and a fixed amount here. So that's really the difference between variable and absorption costing. And then if we move down to activity-based costing, this is the case here where everything is going to be capitalized in inventory here. Nothing is going to be expensed. So with activity-based costing, you got all the direct materials, your direct labor, your factory overhead, variable and fixed portion, and also your selling and administrative expenses here, variable and fixed. Everything is going to go into these activity cost pools, and then they're going to be drawn out of the activity cost pools, and then as needed here, depending on the product, and then they're going to go into inventory and they're going to be capitalized. So you see, activity-based costing, this would be the greatest amount would be sitting in inventory because everything is getting going in and being capitalized in the inventory here, versus nothing is being expensed here. The other three methods, we had difference between what's going into our inventory versus what's getting expensed. Okay, so that's our activity-based costing. Now, one other thing here. If we look at this, you lay this out in terms of cost flows to understand what is your different costing methods, and you're going to have to determine your different cost flows for each of those costing methods. And you'd be tracking your inventory into your work in process. You'd have those different factory costs here, plus it could be some overhead costs for selling and administration, but nonetheless you're going to have your factory costs for direct materials, direct labor, and overhead. You're going to have to determine what those are, and those are going to flow into some inventory account here as work in process, and then they are taken out of work in process, go to finished goods, and they're going to then go into the cost of goods sold and be expensed against the sales for the period here. But nonetheless, what you have to do using these different costing methods, you have to track those costs that are they're all asset accounts here. They're all going, those costs are going into your different inventories here as work in process, finished goods, and then they're going to be expensed out here in cost of goods sold. And then the other thing is you have to, these other costs that aren't included in your inventory, all those expense that are going to be expensed during the period, there's going to be some, you're going to have to determine the different factory amounts, and then you're going to have to add to it any of those selling and administrative costs. And those aren't going to be going into the inventory accounts. They're not going to be part of the cost of goods sold. They're just going to be period costs for the period here. So just looking at that cost flow, or just look at how you'd have to determine using these different costing methods to understand what costs are flowing into your inventories here. You'd start out with your factory costs again, direct materials, direct labor, and overhead, variable and fixed. You'd have to determine what those amounts are, and then those would be, you'd accumulate those as your total manufacturing costs. Then they're going to move into some work in process account here. So you have some beginning work in process. You'd have to add to it the total manufacturing costs you have here for the period that you have. And then you would subtract from that your ending work in process. And that would give you your cost of goods manufactured here for the period. So those cost of goods manufactured are going to move into some finished goods account here. So then you take your beginning finished goods, you add to it all those cost of goods manufactured here, coming out of your work in process, and then you'd have to subtract from it the ending finished goods. So that's going to be your cost of goods sold, and they're going to be accumulated into the cost of goods sold here, and they're going to be expensed for the period. So whatever inventories you're using here for the period are going to be, that are being sold here, are going to go into the cost of goods sold account, and they're not going to be sitting in these inventory accounts. But you're going to end up with some inventory here sitting in your work in process in your finished goods, possibly here, depending on if you oversold or undersold your amounts here. And that's what we're talking about, this inventory valuation methods. There's 4 different methods that we're looking at: the throughput, the direct or variable costing, and your absorption, and also your activity base. So each one of those is going to produce different amounts that are going into your work in process, finished goods, and also what go against your cost of goods sold. Okay, and then again, you have to determine what's being expensed here, not included in your inventory here, versus, and then that amount would be period costs and be expensed against the sales for the period. So if we just look at, let's just look at how we would lay this out here based on our cost flow here, looking at some income statement or determining our operating income here. And we'll just base it on variable costing. So what you're going to do here, the idea is this. You really want to trace through here and determine in each one of these methods, you're going to have a certain income statement type or determine your operating income. But you'd have to trace those different costs based on what you have included in your inventories, and you determine the amounts that would be sitting there. And we just use this format here where we're going to have some direct material used. You have some beginning materials here for the period, add to it any purchase material, subtract out any ending material balances that you have, and that's going to give you your direct materials used here for the period. And then your manufacturing costs, there's going to be your direct materials used, plus any direct labor. And in a case here of variable costing, it's only going to be variable factory overhead. Those added together, those are going to give you your total variable manufacturing costs. And then again, this is just based on variable costing. Each one of these different methods is a bit different here. But then looking at our cost of goods manufacturing, we just take those total variable manufacturing costs, add to it the beginning work in process here, subtract from it the ending work in process, and that would give us our variable cost of goods manufactured. So then our cost of goods sold would be a variable cost of goods manufactured plus our beginning finished goods minus our ending finished goods, and that'll give us our variable cost. And then in this case we have this manufacturing margin here under variable costing. We just take our sales for the period here, subtract from it our variable cost of goods manufactured. That gives us our manufacturing margin. And then we have a contribution margin here based on variable costing. Manufacturing margin minus the variable sales and administrative expenses. That gives you your contribution margin here. And then income before taxes, or your operating income, would be your contribution margin that you have here. Subtract out your fixed factory overhead and also those fixed selling and administrative expenses. So that's going to give your operating income or your net income here before taxes. I went through the variable costing here just looking at the income statement. They're all a bit different here, but that was, you have to go through each of these determine your income statement and your operating income here and what's sitting in inventory and so forth, just looking at these, your different cost flows that you have here. And just for comparison purposes here, this is the case here. I'm not going to go through the arithmetic here, but you'd have to trace those costs through. And we're looking at absorption versus variable costing here. So absorption would have a greater inventory cost here versus variable costing here. Variable costing is going to have a less of an inventory cost versus absorption. So just, this is the idea here. To determine our operating income, in the case here, where again, our absorption costing has a greater inventory cost versus variable costing. Using absorption costing, your operating income here would be greater than the variable costing operating income when inventory increases here. And then absorption costing operating income will equal variable costing operating income when inventory is the same. And then the case here, absorption costing operating income will be less than variable costing operating income when inventory decreases. And that's all based on operating income here. So just went through these 4 different methods here, and you can use, you look at these different methods here and what different costs are being tracked into your inventory, and then you can make comparisons here between the different methods. You'd have to, again, you might want to look at absorption costing versus throughput, or full absorption versus activity costs, or variable and so forth. But the idea is here just based on what we're looking at here. With absorption costing, where the inventory cost is greater than variable costing here, you have this relationship set up here. Just to understand that. All right, so that'll end our discussion here with tracing our inventory cost using these 4 different inventory valuation methods.